Hello everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 8. This lecture is in continuation with lecture number 7, in which we discussed Ind AS 34, the provisions and the concepts. Now in this particular lecture, we will discuss ICAI, examples, illustrations and question and answers. Okay, so for this, please refer ICAI module, the updated one. You will find it on BOS portal of icai.org. Otherwise, you can find it on the app as well. Okay. Please take out page number 11, that is 2.82 of ICAI module. Okay, we'll first go through some examples and illustration, and in the end we'll head towards question answers of chapter number 2, unit number 2, that is interim financial reporting. Okay, these examples just give you provide you some better understanding about the concept. For example, as you know, the interim financial statements are the statements that are prepared for a shorter period. They are prepared in the middle of the financial year. Okay. Now, in this case, what sort of accounting policy should be followed? In general, the basic rule is what? You have to follow the same accounting policy as per the last financial statement that you have reported. For example, if we talk about quarter number 2, the last financial year last annual statement is, for example, the last annual statement is 31st March 2022. Okay, so you have to follow for all the subsequent quarters, quarter 1, quarter 2, quarter 3, quarter 4 of the next year. You have to follow the same accounting policy as followed in the last annual FS. Okay, the policies that you mentioned and followed while preparing the annual statements of 31st March 2022. This is example. Okay, now you can change it only and only when there has been any change from this particular date. For example, if we talk about quarter number 2, okay, if you are providing some interim FS, okay, interim FS for quarter number 2, so you will have to apply the same accounting policy unless and until there has been any change. The change is considered year-to-date basis. What is year-to-date basis? Year-to-date basis. This means, for example, if we talk about quarter number 2, that is 30th September 2022. Okay. Now, year-to-date means quarter 1 plus quarter 2. I have told this concept in the lecture number 7 as well while I was explaining the concept. Okay. So, this quarter number 1, quarter number 2 is year to date, okay, till now, from the beginning of the financial year till the quarter end for which you are presenting the reports. So this is known as year to date. So this policy change is compared from the annual financial statement last year that you presented, and from then what change have been brought in for the accounting policy. If any change, then only you will be applying new accounting policy to the interim financial statements. You will be providing it as a note as well. Okay. Now, these changes involves the accounting estimate changes. Estimate changes, for example, if we talk about at the financial year end, last financial year end, you were assuming 2% bad debts provision, for example. Now, at the quarter end of second quarter, okay, second quarter end, you are assuming it should be increased to 5%. This is estimate change. You were previously assuming 2% change in the last financial statement, last annual financial statement, and in the interim financial statements for the quarter 2, your estimates have been revised and now it is 5%. Okay, so this will be considered. Next, revenues received cyclically. That means at times, okay, for example, every month, every June you are receiving some amount, or occasionally you don't know when it will be received. For example, dividend, you don't know when the company will be announcing it, when it will be credited to your account. Okay, will it be credited this year or next year? You don't know it. So occasionally or seasonally at times, for example, if you talk about, there are certain businesses who have seasonal high revenue, and the other when it is out of season, then there is certainly very low revenue. For example, if we talk about air conditioners, AC, okay, there are summer times when the revenue is high, too high, okay, and there are times when there is no sale or very negligible sale. Okay, it happens. So seasonally. So how to record in the interim financial statement? Okay, the quarter, it might be that for a particular business, quarter 1 might have exclusively high sale, whereas quarter 2 and 3 will be having very less sale. So how to record it? Should we record it on SLM basis equally, or should we record it as and when it occurs? So there is a rule that you will not defer, you will not defer, you will not postpone if any revenue has been generated. Okay, if quarter 1 has high sales, then you will be recording such high sale in the quarter 1 while you are preparing the interim FS. Okay, this is a golden rule over here. Same goes for the cost. So here there is a very important thing that you have to keep in mind is revenues that are received seasonally, cyclically or occasionally within a financial year shall not be either anticipated, will not be forecasted, neither it will be deferred, it will not get deferred. Okay, as of an interim date, if anticipated and deferred, unless and until it is appropriate to defer. Okay, general rule is that you will not postpone, you will not anticipate, you will not defer. It will be recorded as and when in the certain quarter in which it actually occurs. Okay, same goes for certain entities earn more revenue in certain interim periods of financial year than other interim periods. Such revenues are recognized when they occur. This is very important. Keep in mind, even questions occur, and if you are reading as a professional, it is very important while presenting interim financial reports. See, your entity is choosing to present interim financial report. If so, then you have to follow this rule. If your revenue is not in a regular way, it is irregular, occasionally high and low, then you have to record it in your financial statement as and when it occurs. Next, cost incurred unevenly. There are at times then when cost incurs unevenly. For example, if we talk about AC business, the manufacturing pre-summers will be high. There might be extra number of labor, extra material and all involved. Whereas if we talk about the period which is not seasonal, which is having correspondingly less revenue, in that period might be you will be manufacturing lesser amount, you might be needing less material, less cost, less labor and all. So this is where there is high and low cost, uneven cost, no regular cost is there. Okay, in that case also what you need to do, please keep in mind, please read it carefully. Costs that are incurred unevenly during the entity's financial year shall be anticipated or deferred for interim purpose. It should not be deferred unless and until it is appropriate. Or it will be deferred and only if it should not be anticipated, not be deferred. It should be deferred and anticipated only if there is one condition, that it is appropriate to do so. Okay. It is also appropriate to anticipate or defer the type of cost at the end of the financial year. Okay, if at the end you can defer this, then only you should defer it for the interim periods as well. Okay. Certain examples are given. We'll read them one by one. Employer payroll taxes and insurance contributions. Before that, I'll come to a point that how are income taxes paid on an individual's income. It is slab rate basis. Okay, certain different level of incomes will be having different rates. Okay, whereas if you talk about flat rate, there is no flat rate on the salary income. Okay, are you sure? Now there is TDS deduction. What is TDS? Tax deducted at source. So it is employer's duty and responsibility to deduct a certain amount of tax, okay, and then pay the remaining amount to the employee. Okay, this is very simple concept. Now what happens is, the slab rate wise, the income tax is very much fluctuating for the whole of the year. Now what it does it on the average estimated basis. How it is done? What it is done, like for example, if a employee has 12 lakh salary, okay, 1 lakh each month. Now we calculate on slab rate basis. Okay, on slab rate basis a tax is calculated. On slab rate basis, tax is calculated for the whole annual year. For example, okay, to simplify it, what we do is we calculate on the slab rate basis, and for example, okay, just for understanding, your tax for the annual year, for the full year is, for example, 1,20,000. Now it is divided by the number of months, that is 12 months, and each month 10,000 will be deposited to the department as TDS. Okay, now here what is followed? It is followed weighted, a simple average is followed, okay, of the estimated revenue. See, if employer payroll taxes or contributions to government sponsored insurance funds are assessed on an annual basis, the employer's related expense is recognized in the interim periods using an estimated average annual effective payroll tax. And how it is done? Even though a large portion of the payments may be made earlier, okay, at times there are insurance, it is always made in the January month, for example. So it may be higher, too much in January month, whole amount is paid in January month, whereas other, and the benefit is provided throughout the year. Okay, this can be the case, and there can be a case of payroll taxes, as I told you about TDS. For example, TDS equals to 10,000 per month. Okay, so you use estimated average annual effective rate, estimated average annual effective rate. Okay, a common example is an employee. This, how to calculate this, we will also discuss in certain practical examples that are given ahead of this, afterwards, in further lecture, in this particular lecture, but in later part of this lecture. Okay, a common example in an employer payroll tax or insurance that is imposed up to certain maximum level of earnings per employee. For higher income employees, the maximum income is reached before the end of the year. The employer makes no further payments through the end of the year. Okay, it is made in a constant way, like SLM basis, instead of making higher payments in some months and lower payments in other months. Okay, how it is done? It is done by using estimated average annual effective rate. This is simple example of estimated average annual effective rate. Okay, major planned periodic maintenance or overhauls. Okay, some repair and maintenance there. If it is planned, if it actually occurs, then only it is recorded. Other than that, it is not recorded. If you are just planning to it, or if you have any intentions to do it, this will not suffice to record it. It will be recorded when the actual maintenance and repair has been taken. Other than this, if there is AMC contract, that is annual maintenance contract, has been done, then it will be distributed throughout the year. Okay, if there is AMC means annual maintenance contract has been signed, that for the year you will be coming every month and checking this and all, and the amount will be, for example, 1 lakh rupees. If the deal is done, if the contract has been signed, then it might be, it is okay, it is like correct to record it month wise, okay, to expand it throughout the period for which the benefit is being received. But if you have no such contract, okay, if you just have plan and all, then you will be ignoring it, and you will be recording it in your accounts as and when it actually occurs. Provisions are recognized by an entity has no realistic alternative but to make a transfer of the economic benefits. If you have no other alternative to avoid it, okay, but you have to make such payments, then you will have to make provisions. Okay, this can be adjusted upward and downward at end of every interim quarters, okay, and at the end of financial year as well. Okay, benefits as a result of an interim that have been created legally or constructive obligation. You will be making a provision only and only when it is legal and constructive obligation is there. This means what? That there is a law, there is a statute, or there is a contract deal according to which there is no alternative to avoid it. Instead, you have to pay it. If such is the case, if there is contractual obligation, then only you will be recording such provision in that particular interim period. Okay, recognize, and any upward and downward recognition will be diverted to the P&L. For example, you have provided a provision for some particular PF provision, gratuity, etc. Okay, for example, 10 lakh rupees. Next quarter, it has been revised to 9 lakh rupees. This 1 lakh extra will be reversed from the P&L. The standard requires that an entity applies the same criteria for recognizing as applied to the annual statements. Year-end bonuses. This is also recorded only and only when it is contractual, it is legal. Okay, there is contractual obligation. Any voluntary or irregular payments will not be recorded. Okay. Now, a bonus is anticipated for interim reporting purpose if and only if the bonus is legal. Either it is legal or from the past practice there is contractual obligation, or there has been past practice that every year there has been a particular company pays every year 10,000 rupees Diwali bonus. Okay, it is past practice, would make a constructive obligation. Secondly, reliable estimates can be taken. For example, you know how much approximately the amount will be of such bonus. Firstly, either there is legal requirement, constructive obligation, or it is past practice. Secondly, you can make a reliable estimate of the amount that should be recorded as a provision. Okay, variable lease payment, contingent lease payments obligation can arise in the interim periods. Okay, an example of the legal and constructive obligation that is recognized as a liability. If a lease provides for contingent payments, that means what? For example, on certain happening or non-happening of particular event. For example, if you are talking about anything, okay, if this damage is done, or if this building has been recreated, okay, anything good or bad happens, then such particular payment will be paid. If it has contingent provisions based on the lessee achieving a certain level of annual sales, okay, an obligation can arise in the interim periods. If it is dependent on the lessee, okay, then lessee might achieve that particular target anytime. Okay, it can be even middle of the year, it can be in any quarter. Okay, then obligation can arise in the interim periods of the financial year before the required annual level of sales have been achieved. If that required level of sales is expected to be achieved and the entity therefore has no realistic alternative but they have to pay it, they have no alternative to avoid such payments but to make the future lease payment, then they can record this lease payment. If they have any contingent payments, contingent outflows, if it is dependent on something and that particular thing is very much probable that this will be achieved, okay, if you are finding such intentions, then you can record such contingent lease payments. Next, intangible asset. Okay, an entity will apply the definition of and recognition criteria for an intangible asset in the same manner an interim period or as in the annual period. Okay, it will be recognizing as per the same accounting policy as you have applied for the annual ones. Okay, no doubt in this. But in case cost incurred before the recognition criteria for an intangible asset are recognized as an expense. Cost incurred after the specific point in time at which the criteria are met are recognized as part of the intangible asset. Okay, as you know, before such recognition criteria, it goes to P&L, and after recognition, it gets capitalized and added to the asset part. Okay, as you know. So if this happens, then deferring cost as asset is, and in an interim balance sheet is the hope that the recognition criteria will be met in the financial year is not justified. Then you cannot defer such cost. You have to directly put it into the P&L or take it to the intangible asset and capitalize it. There is no midway out. Okay, you cannot defer it, anticipate it, okay, unless and until the particular standard justifies it and ask for it. Okay, are you clear with this? Because the normal provision is that either you take it to the P&L before the recognition criteria is met, and after recognizing it, after getting the recognizing criteria met, then it will be recognized in the balance sheet. Okay, it is eligible for recognition in the balance sheet, and then you will capitalize such particular amount in the balance sheet. It's fine, it's totally fine. Now, but such information is there is no way to defer such cost. As for the revenue, same applies for the cost. You will not defer and anticipate unless and until it is appropriate to do so. Vacations and holidays and other short-term compensated absences. That principle is also applied at the end of interim financial reporting periods. Conversely, an entity recognizes no expense or liability for non-accumulating compensated expenses at the end of the interim reporting period, just as it recognizes none at the end of the annual reporting period. Anytime if it will not be recorded for the annual period, it will also not be recorded for the interim periods, because you are following same accounting policy as of the annual. Okay, if something should not be recognized as per the annual financial statements, such particular transaction will also not be recognized as per the interim financial statements. Okay, other planned and but irregular cost, record only and only when actually incurred. I've told you this concept. You have to record it in the books of account when and only when it actually incurs. If you are planning it, if you have intentions to do so, or any probability is there, you will not be recording such amount. You will, and if it is incurred, you have no right to defer it or anticipate it. Okay. Next, measuring interim income tax expenses. The rate that would be applicable to the expected total annual earnings. What you have to do is you have to estimate the annual income. Then on that you have to estimate the annual tax that will be payable. You have to divide such in over the period of time and then record it in a particular interim financial quarter. Okay. That is the estimated average annual effective income tax rate applied to the pre-tax income of the interim period. Income tax is assessed, it is always assessed on the annual basis. As I told you about the TDS amount, you calculate such amount for the whole year, then divide it throughout the year, spread it throughout the year. Okay, this is known as estimated average annual effective rates. Okay. Next, contractual or anticipated purchase price changes. Okay, for example, there have been any discounts announced. Okay, for example, for the year for the Diwali year end or October end, if you are able to sell 1000 units, you will be receiving 10% extra discount. Okay, any such contractual or anticipated price changes are there. There are further discounts, changes, vouchers, or due to any other reason there are any price changes. How will it be accounted in the transaction? Okay, accounted in the financial statement. Volume rebates or discounts and other contractual changes in the price of raw material, labor, other purchased goods and services are anticipated in the interim periods by both the payer and the payee. The receiver and the payer both estimate on their own. If it is probable, there are high chances that they have been earned and will take effect. If there are high chances, if they are probable, thus contractual rebates and discounts are anticipated, but discretionary rebates and discounts are not anticipated. Okay, if there are probable that you will be achieving a particular target and it is highly probable that you will be receiving such particular discount, rebate, voucher, price change, then you will be recording it, you will be anticipating it. It is fair enough, genuine enough to anticipate it, to forecast it. Okay, if there are less chances that you will be able to meet such target, and since there are less chances to meet such target, there are very less chances of achieving such discounts, rebates and vouchers and price changes, then you will not anticipate it, not forecast it or forecast it or consider it. Conceptual framework that an asset must be a resource controlled by the entity as a result of the past event, and that a liability must be an obligation whose settlement is expected to result in an outflow of resources. Okay, there must be high chances. If high chances are there, then only you will be recording it. Depreciation and amortization, same. Inventories have same principles. Okay, it has to be applied as equal to the annual policies. Same NRV will be taken. Interim periods manufacturing cost variances, if any, will be recorded, will not be anticipated or deferred. It will be recorded in the particular interim period in which it actually occurs. Foreign currency translation gains and losses. Okay, what are these? For example, if you are paying something, okay, and if you are dealing it, you are buying and purchasing, purchasing and selling into foreign countries, okay, and from foreign countries, then there are at times debtors, creditors and income and expenses in foreign currency, but for reporting purpose you have to report in our reporting currency, that is rupees. So for that purpose, for reporting purpose, you will have to revalue it. Okay, you have to convert it to rupees and then see what amount it will be recorded. It is always recorded in rupees for reporting purpose in India. In such case, there might be exchange rate difference, okay, and due to which there arises exchange rate currency fluctuations, okay, changes, price differences, and this is recorded. For income and expense, it is always taken to P&L part, and for in case it is related to liability and asset, then it is transferred to balance sheet part. Specifies how to translate the financial statement for foreign operations into the present currency. It is all done as per the Ind AS 21. You will learn over there as well. But here what it is important is that for in case it is related to income and expenses, then you will be taking the average rates and transferring it to P&L itself. And if we talk about the currency exchange differences which is related to asset and liability, it will be taken to balance sheet portion. Okay. See, read it once. The effect of changes in foreign currency, foreign exchange rates specifies how to translate the financial statements for foreign operations into the presentation currency. Presentation currency means the currency of the country in which it is being reported. Okay. If we talk about India, if you are doing reporting for the Indian government, as per Indian company, then the presentation currency is the reporting currency, which is rupees. Including guidelines for the using average or closing. Average is taken for income expenses, closing rate is taken for incomes and liabilities and assets. Foreign exchange rates and guidelines for recognizing the resulting adjustments in profit and loss or other comprehensive income. Consistently, in Ind AS 21, the actual average and closing rate for the interim period are used. Entities do not anticipate such future changes. They will not defer or anticipate any changes. It will be done as and when it is actually recorded. Okay. If Ind AS 21 requires translation adjustments to be recognized as income and expenses in the period in which they arise, that principle is applied during each interim period. Okay, you have to recognize it as and when it actually occurs. Okay. Use of estimates. For example, to ensure that the resulting information is reliable and that all the material financial information is relevant, it should be relevant and reliable. Okay. To an understanding of the financial position or performance of an entity is appropriately disclosed, then you have to use of estimates. Then only you can make use of estimates. Okay. If they provide a better picture, they are more reliable, they can be reliably calculated and are relevant for the decision making of the user. If yes, then only you will be using the estimates. The preparation of interim financial reports require greater use of estimations in comparison to the annual reports. In annual reports, you have a more clearer picture in comparison to the interim reports. Since there is interim report has has more of ambiguity, more confusions in comparison to the annual figures, because annual figures are clear, whereas interim are yet to be achieved. It is dependent on the more other quarters. Okay, so since it does not have any proximate, okay, they have to make some assumptions, they have to take estimates. Okay, so it is said that interim financial statements use and exercise more estimates in comparison to the annual statements. Okay. Now, if we talk about, these are last examples. If we talk about inventories, for example, full stock taking and valuation procedures may not be required. If we talk about interim, you can skip these part. Full value taken and all is not required. It will be done in the annual periods. Okay. So, interim period financial reporting can be made easier by reducing some steps, by ignoring some steps, and this is allowed by Ind AS 34. Okay, you can skip some parts, you can skip the video, you can skip some actions. Okay, it is not compulsory to take full stock taking. Okay, and valuation procedures. It may be sufficient to make some estimates. Next, provisions. I have told you about, for example, bed debts and all. Pensions, for example, Ind AS 19 tells you that employee benefit requires that an entity determine the present value of defined benefit obligations and the market value of plan asset. Okay, this is a provision. Might be you will not understand over here, but I will try to make it clear that Ind AS 19 says that any planned defined benefit obligation that you have to make, what you need to do, this is your obligation that you have to make a payment, so you make a provision for that. Okay, it is well and fine, but this payable liability, for example, is of 50 lakh rupees. What you do, you simultaneously park some 50 lakh rupees, okay, in a particular asset or in diversified asset. You park it separately, so whenever the obligation arises, such particular parked asset, the asset that have been kept separately, can be realized, encashed, and can be used for payment of such obligation as and when the such particular employee benefit obligation arises. Such asset or such amount which has been parked separately are known as plan asset. Okay, so there is a provision that you have to determine the present value of the defined benefit obligation and the market value of the plan asset, the asset that you have kept for meeting the obligation. And encourages an entity to involve professionally qualified actuary. Okay, these all calculations will be done and valuation will be done as by the actuary. Such actuaries are experts in calculating such figures. They are highly qualified. You have to pay a lot of amount to them, and it is quite time taking and costly. Okay, so you can skip this part for the interim periods. You can take it for annual periods. Okay, you can exercise such calculation part by the actuary on the annual basis. In measurement of the obligation, for interim reporting purposes, reliable measurement is often obtainable by extrapolation of the latest actual valuation. You can subdivide such actual valuation throughout the year and use it for the interim periods and refer the actual revalued figures at the end of the annual financial statements. Okay. Next, contingencies. The measurement of contingencies may involve the opinion of legal expert and other advice. Okay, formal reports for independent experts are sometimes obtained with respect to contingencies. Okay, what you can make is you can make your opinion, and such other contingencies and uncertainties may or may not also be needed for the interim dates. You do not need to reassess it every time for the interim financial statements because it is quite time taking and costly affair. Okay, you can do it for the annual statements. Last, intercompany reconciliations. Some intercompany balances that are reconciled on a detailed level in preparing consolidated financial statements that you prepare for the annual statements. Okay, your end might be reconciled at a less detailed level while preparing the interim financial statements. Okay, there is a relaxation given as per Ind AS 34 while preparing interim financial statements that you can skip some steps, you can take estimates, you can use estimates, you can take approximation, you can take the annual figures, accounting policies for the interim financial statements. Okay, you can prepare figures at a lesser detailed version. Okay, you can skip some steps. This is all relaxation given as per Ind AS 34. Now we will head towards illustration number 1. Company A has reported 60,000 pre-tax profits. Okay, this is what pre-tax profits without tax. It is 60,000 profit for the quarter 1 and expects a loss of rupees 15,000. It is very important to read the question carefully. In the subsequent quarters. Okay, expects a loss of 15,000 each in the subsequent quarters. So see, quarter 1 has 60,000 profits. Okay, you have plus. Now quarter number 2, 3 and quarter number 4, you have 15,000 and 15,000 what? Minus. This means your profit will be net for the annual year only 15,000 because you will be deducting this 45,000 loss from 60,000. Your net profit for the annual year will be net profit. Net profit will be what? Annual will be rupees 15,000. Okay, 60 minus 45. Okay, are you clear about this? It has a corporate tax slab of 20% on the first 20,000. If your profit is some value, then first 20,000 will be taxed at 20%, annual earnings, and 40% on all additional earnings. For example, if you are earning 21,000, 20,000 will be rated with 20,000 slab rate, and for the remaining 1,000 it will be treated with 40%. Calculate the amount of tax to be shown in each quarter. See, now you have to use estimated average rates, estimated average effective rate. Here you will learn this. Please carefully see how it is calculated. Now you have 15,000 income. Now the tax will be, first 20,000 it is 20%. So the tax for the annual year will be 20% on such 15,000. Such amount which appears is rupees 3,000. You will divide this 3,000. You will divide this 3,000 with 15,000, that is, and take out a percentage of the tax. You will apply this to each and every quarter. The amount that you receive by dividing 3,000 with 15,000. The tax amount divided by income amount. Annual tax divided by annual income into 100 will give you effective rate. This effective rate is used for each quarter. And total tax outflow for the annual financial year will be rupees 3,000. You can cross check this. See how the solution is given. Amount of income tax expense reported in each quarter would be as follows. Expected total income is 60,000 in the first quarter and 45,000 loss for the quarter 2, 3 and 4. Now this becomes 15,000 your total income for the annual year. Expected tax as per the slab is rupees 3,000. Please tell me in case of doubt. The annual rate is 3,000 divided by 15,000 equals to 20%. Now for each quarter 1, 2, 3 and 4, the tax will be 20% of 60,000, 20% of 15,000, 20% of 15,000, 20% of 15,000. Now 12,000 minus 3,000 minus 3,000 minus 3,000 equals to 3,000. So this is the annual tax which will be divided as per the quarter in each year. So while preparing interim financial statement, practically you have to make a tax, make a tax provision. You have to consider it 12,000. For the quarter 2, you will deduct 3,000 and take it to the P&L. For the quarter 3, it will be again 3,000 less. Now there is a question that might hit your mind, that if you know already that there will be 3,000 amount of tax outflow, then why are we calculating 12,000 for the first quarter? Because this is a question, this is a certain scenario given to you. But in actual, when you are actually preparing any financial statement, interim period reporting, you do not know what will happen in the next quarter, what will happen in the next to next quarter. So for the current quarter 1, you have 60,000 profits in your hand. So you will be providing a tax of 60,000 for this particular year, 20% rate. Now in the next quarter, what happens will become very much clear only and only when the quarter ends. Then you will be applying this amount. So particularly for interim statements, you have to take out an average rate, average estimated effective rate, and calculate it in this way. And for exam purpose, revise this solution as many times as possible, because the same question might come. Next, the pattern remains same, the figures might change and all. Question number 2, illustration number 2, page number, what is the page number? 2.88. Are you able to catch up with me? ABC Limited presents interim financial reports quarterly, every quarter. On 1st April 2001, ABC Limited has carried forward loss of 600 lakh. For quarter 1, they have from the previous financial year, they have carried forward 600 lakh losses for the income tax purpose, for which deferred tax asset has not been recognized. ABC Limited earns 900 lakhs in each quarter. So 900, 900, 900, 900. 4 times it is receiving. That means 3600 lakh annual profit, annual income you can say, for 30th June, 30th September, 30th December and 31st March 2002. Excluding the carried forward loss, you have not deducted the loss at all right now. Income tax rate is what? Expected to be 40%. Straight rate is given, no slab rate is given. Calculate the amount of tax expense to be reported in each quarter. So now you have 900 lakh income, 3600 income and 600 losses. Okay, so total net income is now 3000 and the tax rate is 40%. Okay, calculate it. So 3000 into 40% is 1200 lakh rupees tax is there. This will be further divided with total income. Okay, you know tax upon annual income. Annual income into 100 gives you the rate. Now this 33.33% is the rate of tax. Now you will be preparing, if you want to prepare this format, then you will be preparing quarter 1, quarter 2, quarter 3, quarter 4, 900, 900, 900, 900, okay, 4 times, and then you will be applying the tax 33%, that is 300, 300, 300, 300, okay. Since the figure was same for each quarter, that is why it has been provided, has been presented this way. You can present it as per the previous example as well, illustration 1 as well. Okay. Illustration number 3. Innovative Corporation Private Limited, ICPL, is dealing in seasonal product. Do you remember something? If there is seasonal, cyclic or occasional, then you do not need to defer or anticipate. You have to record it as and when it occurs in the particular quarter. Okay, so quarter 1 10%, 10%, quarter 3 60% and quarter 4 20% of the revenue is your, okay, sales. Now for the first quarter ending 30th June 2001, ICPL has provided the following information. Sales is 70 crore, employee benefit expenses 25 crore, administrative and other expenses are 12 crores, finance cost is 4 crore. Okay, for the first quarter, this is the figure of first quarter. This is the figure of first quarter. ICPL, while preparing interim financial reports for the first quarter, wants to defer 16 crore expenses to the third quarter. Is it possible? No, because we know cyclic, seasonal and occasional incomes are not allowed to be deferred and anticipated unless it is appropriate. Okay, so now ICPL wants to defer 16 crore to the third quarter. On the argument that the third quarter is having more sales, therefore third quarter should be debited by more expenditure. Okay, as you know, 10%, 10%, 20%, and this quarter 3 is having higher sales. So ICPL is telling that, is commenting that they should report the taxes 60% to the quarter 3. Okay, such amount from here should be deferred to quarter 3 because there is higher sales in quarter 3. Considering the seasonal nature of the business and that expenditures are uniform throughout all the quarter, calculate the results of first quarter as per Ind AS 34 and comment on the company's view. Okay, so the expenses are throughout, the expenses, that is 25, 12 and 4 are throughout the year similar on a regular basis, constant basis. There are no ups and downs in the expenses throughout the year. How you will make? You have sales for the first quarter. You will not defer it, you will not anticipate it. You will record whole 70 crore in the quarter 1. No issues, this is quarter 1. Now total revenue is 70. Now you will be preparing whole of the expense 25, 12 and 4. All the expenses will be recorded in that particular period itself. No deferment, no anticipation will be done. Okay, total tax expense, total expense is 41. 70 divided by 70 minus 41 is 29 is your profit. As per Ind AS 34, the income and expenses should be recognized when they are earned and incurred respectively. They should not be deferred they should not be deferred, not be anticipated unless it is appropriate to do so. Recognized income, seasonal incomes will be recognized when they occur. Therefore, the argument of ICPL is not correct. While attempting the answer, you have to write this line, okay, that what we are doing and what is our final conclusion. Let's head towards illustration number 4. Fixed production overheads for the financial year is 10,000. Normal expected production for the year after considering planned maintenance and normal breakdown, also considering the future demand of the product, is 2000 MT metric ton. It is considered that there are no quarterly or seasonal variations. Okay, there has been a production overhead of 10,000 and 2000 metric ton has been future demand. Therefore, the normal expected duration for each quarter is 500 metric ton. For each quarter, quarter 1, 2, 3. Annual is 2000 and for each quarter it is 500, 500, 500. The fixed production overhead for the quarter are 2500. Okay, so this is 10,000 in total. For each quarter it is equal 2500, 2500, 2500 and 2500. And for income purpose it is 500, 500, 500, 500. This is all expected. What is actual? Let's see. Actual production achieved. Actual production, it should be 500, 500, 500, 500. But here in the first quarter it has achieved only 400. In the second quarter it has achieved 600. In the third quarter 500 is equal to 500 and in fourth quarter they have achieved only 400. So 2000 was the target but they have achieved only 1900. Okay. Presuming that there are no quarterly or seasonal variations, calculate the allocation of fixed production overheads for all the quarters of Ind AS 34. Read with Ind AS 2. Okay. Will the quarterly results affect the annual results? Okay, will they affect the annual results? Let's see. See the solution. As per 500, it should be 2500 per year. This means 2500 is the cost divided by 500 units. Okay, so this becomes rupees 5 per metric ton, per MT. Okay, see this is calculated over here. Now this 5 should be multiplied by 500, but the actual production for the quarter 1 is 400, but the actual production for the quarter 1 is 400. Okay. See, actual fixed production is 2500. Fixed production for overheads based on the allocation at rate 5 per metric ton allocated to production, actual production is 5 into 4, that is 2000. Okay. So you will not defer, not anticipate. Not defer, not anticipate. You will just record it as per the actual production. Okay. So 2000 unallocated fixed cost overhead to be charged as an expense as per Ind AS 2 and consequently as per Ind AS 34 should be rupees 500. See, it should be 5 into 500. Okay. But as per actual, what it is? As per actual, it is 5 into 400. Okay, so this 100 into 5, that is rupees 500, is under recorded, is less recorded. This should be taken to P&L. Now if we talk about second quarter, now the second quarter actual sales is 600, but as per the amount that was expected, it is 500. Now for actual fixed production overhead year to date basis, that is quarter 1 plus quarter 2. Okay, so actual fixed production should be 2500, 2500. Okay, for quarter 1 and quarter 2. So year to date basis means quarter 1, quarter 2, that is 5000. Divide by units, that is 500 plus 500, that is 1000. Then it should be rupees, fixed production overhead should be 1000. This 1000 is from 600 plus 400. Okay, year to date basis. So this is 600 plus 400 units. Okay, now it is multiplied by 5. This 5 amount we have taken it from there. Earlier rupees 500 was not allocated. Okay, here you were known that there is unallocated amount of rupees 500 was not allocated to production in the quarter 1. To give effect to the entire 5000 to be allocated in the second quarter, as per Ind AS 34, 500 will be reversed by the way of credit to the statement of P&L. In the previous quarter, what you did, you transferred rupees 500 to P&L. Now in quarter 2, it will be recorded as per 5000 whole. Okay, because 5000 was the figure, and now year to date basis it should be 500, and on actual basis also it is 5000. Okay, 5000 was expected and 5000 is actual. There is no difference. So since there is no difference, now the difference that was recorded in the quarter 1 will be reversed by removing it from the P&L that was previously charged in the quarter 1. Okay, and was credited to the statement of P&L of the quarter 2, second quarter, and debit to the cost of production. Third quarter, what is the scene? Now you have 500. Okay, it should be 500 and your actual is also 500. It is already matched. There will be no difference. No difference. No under or over recovery. Okay, year to date basis means quarter 1, quarter 2 and quarter 3 year to date basis. Now for the actual fourth period, our actual fixed production overhead on year to date basis is 10,000. Okay, total should be 10,000 and units are 1900 only. Okay, units are 1900 only. Okay, it will be divided, such 500 is under recovery, unallocated fixed expense. It will be expensed off as per the principal Ind AS 2 and charged to P&L. Such amount will be taken to P&L. Unallocated production overhead for the year rupees 500 are expensed in the statement of P&L as per Ind AS 2. Next, illustration number 5. ABC Limited manufactures automobile parts. ABC Limited has shown a net profit of 20 lakh for the third quarter of 2001. Following adjustments are made while computing the net profit. Firstly, bad debts of rupees 1 lakh incurred during the quarter. 50% of the bad debts have been deferred to the next quarter. Okay, 50,000 have been deferred. Are you allowed to defer? Are you allowed to anticipate? No. So such 50%, that is 1 lakh incurred, such 50%, that is 50,000 rupees, should also be considered into the quarter 1 itself. Okay, so thus 20 lakh profit is there, net profit of 20 lakh in the third quarter. Okay, for the quarter 3. So 50,000 should be adjusted. Additional depreciation of rupees 4,50,000 resulting from the change in the method of depreciation. Okay, we'll see one by one answer. The treatment of bad debts is not correct. As you know, not correct. You are not allowed to defer or anticipate. It should be recorded as and then. So whole 1 lakh should be recorded. 50,000 was earlier recorded. 50% was deferred. So only the 50% deferred should be corrected now and should be deducted from P&L. Recognized in the same period. Okay, recognized in the same period. So accordingly 50,000 should be deducted from 20 lakh rupees. Next, additional depreciation, same quarter. It is correct. Okay, there is a additional depreciation. It is charged to P&L. It is correct. No deferment, no anticipation, which is as per the Ind AS 34. It is in line with Ind AS 34 and that's why correct. Exceptional loss of rupees 28,000 incurred during the third quarter. 50% of exceptional loss, that is 14,000, have been deferred to the next quarter. Are you allowed to defer or anticipate? No. 15,000 or 14,000. Okay, that is 50%. 28,000 into 50%. That is 14,000. 14,000 must be deducted. Okay, 14,000 have already been deducted, which is right. But 14,000 more has been deferred to the next quarter, which is wrong. So you have to cancel that deferment and deduct such amount from the P&L in the current quarter itself. So 28,000 into 50%, that is 14,000, is deferred. Now you need to correct it in the current P&L. Treatment of exceptional loss is not as per the principle of Ind AS 34, as the entire amount rupees 28,000 incurred during the third quarter should be recognized in the same quarter. It should be recognized in the same quarter. Hence, the 28,000 into 50%, that is 14,000, which was deferred, should be deducted from the P&L of the third quarter itself. No deferment, no anticipation. Lastly and fourth, rupees 5 lakh expenditure on account of administrative expense pertaining to the third quarter is deferred on the argument that fourth quarter will have more sales. Can you defer? No. Can you anticipate? No, unless it is appropriate. Therefore, fourth quarter should be debited by higher expenditure. The expenditures are uniform throughout all the quarters, so it should be uniformly debited to P&L. Okay. See answer number 4. The cost should be anticipated or deferred only when it is appropriate or incurred unevenly. Okay, if it is incurred evenly, therefore such deferment is not correct. Such deferment is not correct. Okay, so it should be deducted. So finally, what you need to do? You need to deduct 50,000, 14,000, and finally 5 lakh. So 5 lakh 64,000 should be deducted. So 5 lakh 64,000 must be deducted. This is amount that should be deducted. Okay, and net profits were 20 lakh. For 5 lakh 64,000 if deducted, then now new net profit is 14 lakh 36,000. Okay. That is all for the examples. We'll head towards the question answers part. Page number 2.97, there are very simple questions and repetitive. Okay, even you can do it on your own. Please try it. Company A expects, this is homework. You should try it on your own. This is same as we have done for the 60,000 questions. 60,000, 15,000, 15,000, 15,000 were lost. What you need to do? You need to take out your average annual effective rate and then calculate it and transfer it, charge it to P&L for each quarter. If we talk about question number 2, Narayan Limited provides you the following information and asks you to calculate the tax expense for each quarter, assuming that there is no difference between the estimated taxable income and the estimated accounting income. Estimated gross annual income is 33 lakh, out of which estimated capital gains are 8 lakh. Okay, inclusive of 8 lakh. This means if we deduct 8 lakh from 33 lakh, there is 25 plus 8. Okay, so 8 lakh is capital gain and 25 is other income. Estimated income for quarter 1 is 7 lakh. Quarter 2 is 8 lakh. Quarter 3 is 12 lakh, which includes 8 lakh. Okay, so you have quarter 1 7 lakh, quarter 2 8 lakh, quarter 3 you have two incomes, that is 8 lakh plus 4 lakh. This is capital gain. How do you know? Because 8 lakh rupees is capital gain, which is given over here that quarter 3 including estimated capital gain of 8 lakh. Total income is 12 lakh for the quarter 3. 8 lakh is capital gain and remaining 4 lakh is other income. And quarter 4, if we talk about, it is 6 lakh. Okay, the capital gain tax rate is 12%. So this quarter 3, 8 lakh will be charged with 12%. And other than this, other incomes will be charged at 30% and 40%. For first 5 lakh, it will be 30%. It is same. Okay, so first 5 lakh calculate, it should be 30%. And remaining amount, okay, that is 20 lakh should be 40%. Okay, so 5 lakh into 30%, 5 lakh into 30% plus 20 lakh into 40% plus the tax is what? Okay, one more tax is that is 8 lakh into 12%. So this is how your tax will come. and then you have to take out a reasonable rate. You will not calculate 8 lakh for this purpose because it has separately identified income and tax rate. Okay, you will not take it out for the balancing purpose because this 8 lakh capital gain arises specifically in quarter number 3. It is not occurring throughout the year. Okay, so this 8 lakh into 12% will be charged separately. Let's see the answer part. See, 33 lakh minus 8, that means 25 lakh. Tax on other income is 30% on 5 lakh and 40% on remaining. This means 9 lakh 50,000. Weighted average will be 9 lakh 50,000 upon 25 lakh, that is 38%. Okay, so quarter 1 you have to charge 28%. Quarter 2, 38%. 38%. Okay, now quarter 3, 12 lakh minus 8 lakh, that is 38%, and remaining 8 lakh, that is capital gain, will be charged with 12%. And for quarter 4, 6 lakh into 38%. This 38% is weighted average effective rate. Are you clear? Let's see question number 3. An entity reports quarterly earns 1,50,000 pre-tax profits in the first quarter but expects a loss of, it is same, okay, same as above. Wait, there is a twist. The management believes that since the entity has zero income for the first year, its income tax expense for the year will be zero. State whether the management's views are correct or not. No, because we have to calculate on the weighted average basis. Okay, let's see answer number 3. Income tax expense is recognized in each interim period based on best estimate of the weighted average annual income tax rate. Okay, weighted average annual income tax rate. Net income for the year will be zero. No income tax shall be charged quarterly in the interim financial report is not correct. You have to charge it as and when it occurs as per the weighted. You have to use weighted average effective rate. Okay, there is no other way around. Okay, if there are high sales or low sales, the tax income is equal in each year. Okay, each year, or what I am saying is interim periods. For every interim period, it should be on the weighted average basis, on a standard weighted average effective rate. What you have to follow for tax purposes? Weighted average effective rate. Weighted average effective rate. Okay, so first quarter is 1,50,000, 50,000 loss. Effective rate is 30%. It is given in the question. Such amount comes. Okay, that is all the tax is zero, but still you have to charge it this way in the question, as in the interim financial reports of each year. You cannot directly say that since there is zero tax for the whole year, I will not be charging anything in the quarter, because while preparing interim financial statement for the quarter 1, you do not have any idea about quarter 2, quarter 3, quarter 4. Okay, so therefore for 45,000 income you have to report a tax. Okay, for 1,50,000 income you have to report a 45,000 tax. Okay, for the further losses you have to reverse such taxes that you have already provided for in the quarter 1, but you cannot simply record zero tax in all the quarters while preparing interim financial statement. Okay, so this contention is wrong. Next, question number 4. Due to decline in market price in second quarter, Happy India Limited incurred an inventory loss. The market price is expected to return to previous level by the end of the year. Okay, at end of the year the decline had not reversed. When should the loss be reported? When it should be recorded? It should be recorded as and when it occurs. Neither anticipate, don't defer it, don't anticipate it. Record it as and when it occurs. Okay, so it should be recorded in the second quarter itself. Question number 5. An entity's accounting year ends in 31st December, but its tax year ends in 31st March. Okay, the entity publishes an interim financial report for each quarter of the year ended 31st December 2019. The entity's profit before tax is 10,000 for each quarter, and the estimated effective rate tax rate is 25%. 10,000 each quarter is its profit, and 25% is the tax rate. March and 30th year and 30% for the year end 31st March 2020. Okay. How the tax related charge would be calculated? How the related tax charge would be calculated for the year 2019 and its quarters. Weighted average. See, 10,000, 10,000, 10,000 income is there, total becomes 40,000. Okay, you will be charging 2,500 as per the rate. Okay, which the rate is 25% for this quarter, 25%, and further 30%, 30%, 30%. Okay, as it is given in the question. This is all about interim financial statements, Ind AS 34. We have covered all the provisions, the concepts, and the question answers, illustrations, and examples. Okay, in case of any doubt, please reach out to me for full videos, lectures, for full Ind AS course in Hindi and English. Don't forget to check out the description box, download our app, and see you in the next lectures. Till then, take care, be safe, stay tuned.